Okay, welcome back to this part 2 of week 12, where we're going to be looking at, this time, the direct method of the statement of cash flows. In part 1, we looked at the indirect method and did an example of how that works. With the indirect method, just as a quick recap, you're going to briefly look at the income statement, kind of take the net income as a good big summary, and then pick out the pieces that do not involve cash, like depreciation and any gain or losses, and then move on from there. With the direct method, we're going to look, if you want to think of it this way, we're going to look directly at the income statement in particular, and then actually ignore the few items that are not cash related, like depreciation and gain or losses. So this one, we're going to actually go in and look at revenues, and we're going to go in and look at the different types of expenses and see where cash was brought in and paid from that. So let's get right in. With the direct method, there are the 3 same categories, the operating, investing, and financing. However, with the direct method, the only difference between the direct and indirect method is in the operating section. The last 2 sections, the investing and the finance, are exactly the same as the indirect method, as well as the very bottom, where we reconcile the cash to see if it does indeed match our balance sheet into the year total. So when we start with the operating activities, like I said, we're going to look at the income statement as our primary source, instead of, with the indirect method, we just looked at it for our net income and kind of went from there. This one, we're going to look and determine, where did our cash come from? And the first item here is from our general customers, and the main place where our money is going to come from, what we want to look for, is our sales revenue. But we also should know that not all of our sales revenue comes in the form of cash. Sometimes when you make a sale, it's on account. So we're going to want to tweak the sales revenue number by looking at, like very similar to what we did on the indirect method, is there a difference with the AR going up or down? I'm going to actually switch these around. I think it might be easier to read, because this is what I did on cash payments. So if your AR goes down, that means you're actually getting more money than just what your sales revenue said. So not only are you collecting all of your sales revenue, but you're also collecting some of prior people who owed you money. Now, that doesn't mean that none of your accounts this year were on account. It just means that you had less on account this year than you did in previous years, or your customers are just paying faster. So when your AR does happen to go down, that means we got more money. So we're going to add that to whatever our sales total is. And then just the opposite, if your AR goes up, that means you're collecting less. You're collecting less money than you actually thought cash-wise was coming in, because instead of having 10,000, now you have 20,000. Well, that's probably another 10,000 of that. The extra 10,000 came from our current year sales, so that's 10,000 we don't have of that sales. So that's why we're going to subtract the difference here. That's going to be our cash from customers, and then we're going to look at any other revenue sources we may have. Add that in, and then add the 2 numbers together to see how much cash we actually have received. And then we're going to look at our cash payments. Generally, we're going to break this down into 5 sections. You could have more or less depending on the actual accounts the business has. But assuming a typical type business, a corporation, especially it would have to be a corporation to have this item here, the income tax. We'll get to that last, but generally the rest of these will most likely be here. The only difference is if you're not a corporation, you wouldn't have this item. To suppliers. All right, so this is cash payments we make to our suppliers. The biggest cash payments that you usually make are in 1 of 2 places: your wages, and then what you are actually selling, the inventory. And so when you expense out your inventory after you've sold it, we call that cost of goods sold. So anything in cost of goods sold is money that we have eventually paid for to get inventory, and now we don't have that inventory anymore. So that's going to be a big piece of our cash payment. So whatever your cost of goods sold is, that's your big first number. And then we're going to tweak that number by looking at any inventory increases or decreases, So for example, if your inventory increased throughout the year, that means you spent more money than what was actually shown on your cost of goods sold. You got rid of all of that inventory that you sold, but then you spent more money that we need to account for if your inventory went up. And then we need to then tweak it one last time and say, well, if we did spend the money, or if inventory did go up, how do I know that I paid it for cash, with cash? Well, that's when we're going to look at any account payables that we have. If our account payables also went up, well, then maybe we bought some of that inventory on account. Therefore, if our account payable went up, we're going to take back down the difference because that's money we really didn't spend yet. We will. But as of this year, right now, that money has not been spent. If our account payable went down, so we owe all of our people less money, that means I've paid it off. I've paid off some debt. And therefore, if I've paid off debt, that's money, that's extra money that I've spent that I need to account for here in my suppliers. So that's our first section. Then we go to employees. The biggest number is going to come from our wages expense, and then we're going to tweak it just a little bit by determining, by looking at our wages payable account. If our wages payable went up, that means I've saved a little bit of money for the time being, money that's not spent. So out of this wage expense, if my wages payable went up just a little bit, I didn't really spend all of the expenses, so I'll take it down. If my wages payable went down for the year, then that means I've paid extra money, and I'm going to need to add that back in. Okay, for operating activities, this is the last section that has a couple different items involved in it. The operating activities is going to be any other expenses that I have paid for that I haven't mentioned. So not employees, not interest, and not income taxes. Basically anything else, and also not depreciation. Any other operating activities, I need to add those in here. That's money that I have supposedly paid. And then I need to look at, one, this asset account. Did I spend more money on buying prepaid things? So if my prepaids went up, that means I paid more money. So I'm going to need to add that money into my operating expenses for cash payments. And then looking at the liability side, any other liabilities besides the account payable and wages payable, I'm going to do the difference here. These are going to be just like say the wages payable. If my current liabilities go down, I'm spending money for whatever reason to get that to go down, so I'm going to add the difference. Same thing here. If my wages payable goes down, I'm going to add the difference. So all the liabilities work the same. Accounts payable goes down, I'm going to add the difference. Then we're going to get down to our last two when we have interest and then income taxes. A lot of times these won't have a corresponding payable account, at least in our problems. So that's why I just put the plus or minus if a payable account for that does exist. But I don't believe in our homework that it does. So we're going to add up all of our cash payments and then total our cash receipts less our payments to get our final cash from operating. And then, as I mentioned, the investing, financing, and cash reconciliations are exactly the same, done the same way as the investing section. Okay, let's go through an example. Again, I want you to have this page up. I'm not going to have it up anymore, but it would be very wise for you to see what goes into each area. So you'll want to keep this out. And I'm going to pull up now the problem in Excel. Okay, so this yellow was keeping track of everything as I went. I still can do that with the direct method. It's just now I'm going to be dealing with more items down here as I go. Okay, so with the direct method, the first thing we're going to look at in the operating section is cash coming in from our customers. So that's going to be our revenue. So I'm going to go ahead and use that. So $400,000. And let's scoop this up. Okay, so cash coming in, cash receipts. And then off to the side here, you'll see how I get the number. So I can't quite put it all in one screen. Cash receipts from customers. Well, maybe if I made the print a little small, that's 24 font, that's pretty big. Cash receipts from customers, 411,000. So where I get that, the 400,000 coming in from revenue, and then the other part, looking back up to your notes, is to look at the AR difference. AR went down by 11,000. If the accounts receivable goes down, that means I'm collecting more money. So that's why my cash from customers is 400 plus this difference of 11,000. With my AR going down, I'm getting more money. So that's the 411,000. Now, cash to the suppliers. As you'll see, I have three different things going on here. Cash to the suppliers. I say it's 210,000. Well, that actually comes from, if they even themselves out, so you might think, oh, that just comes from the cost of goods sold. Well, true, it comes a little bit from there. That's part of it. 210,000. And then we need to look at our actual inventory, because this is, remember, we're paying out money to our suppliers. One of the big suppliers is when we buy inventory or raw materials. And then I'm going to look at the inventory account. My inventory went down, so I actually saved a little money. I'm going to as a cash payment, I didn't make a payment in that situation. I saved a little money, so I'm going to subtract that difference. So now I'm at 200,000. And then the last thing we look at for our suppliers is the accounts payable. And my accounts payable went down. Now, when accounts payable goes down, different than inventory because it's an asset. When accounts payable goes down, that means I spent money. I can't just, unless somebody just took it off my bill, which I highly doubt, for an account payable to go down, you're going to have to spend cash. So if I spent cash, that's money going out to the suppliers. So that's why I added the 10,000 here as an account payable payment. So what I ended up doing is 210,000 minus 10 plus 10. It evened itself out to 210,000 again. Now to the employees. I go to my wages expense. $20,000 it looks like I spent to my employees, but I need to tweak that number just a bit by any differences in my wages payable. My wages payable went up by 2,000. If it went up, that means I didn't spend all of the money that I did expense. So out of the 20,000 I expensed, I really only paid 18 because my wages payable went up by 2,000. So that's where this 18,000 comes from. The 20,000 minus the increase in wages payable, the money that I have currently saved. All right, operating activities. So we'll go down. I remember depreciation, gain or loss. I don't worry about those on this one. These are not going to happen. So I might as well, I can go ahead and maybe cross those out, put something red in here saying I'm not going to use them. But other operating expenses, it looks like I spent 15,000. But let's make sure. I look at my other accrued liabilities. It went from 3,000 to 2,000. So for an account payable type item or liability to go down, that means I had to pay money. So not only am I looking at paying 15,000, I paid an extra 1,000 there of the other liabilities. And then the other thing I want to look at, besides the operating expenses of 15,000 plus the liabilities, is my last asset account that I'm going to look at is my prepaids. What happened with my prepaids? My prepaids went up by 2,000. If my prepaid account goes up, that means I spent money, but I'm just not expensing it yet. So if I spent money, I need to account for that. That's an addition to cash being paid. So not only did I spend 15,000 here, I spent an extra 1,000 here to get this a liability to go down. I spent another $2,000 here to get my prepaids to go up. So in total, I spent $18,000. There's that. Now the last two are pretty easy. We can just look at the income statement because I don't have any specific payables for income taxes or interest. We look at the interest, $7,000. Income tax here, $50,000. So I got $7,000 and $50,000, and I got those accounted for here. So total cash payment, when you add up all of these, you get $303,000. And now all we're going to do is do the difference here. Cash receipts minus cash payments is $108,000. Compare that $108,000 to the indirect method, and it's also $108,000. So your answer should be the same when you're all done. That's how you'll know if you did it right. And then as you'll see, the investing and the financing activities are identical to the indirect method. So I had 15, 20, and 47. I go back to the indirect method, 15, 20, 47 for a $12,000 negative difference, and that's shown up here. Financing the same, and then finally my cash, when I group everything together, add up my totals, I had the beginning, the change, and the ending, so 90, 20, and 70, and you'll see that that was the same for the indirect method. So the only difference happened to be the operating activities. Now notice I do have a separate problem here, and I'll leave this one for you to go through on your own. I'll just highlight a few items. Not everything involves cash, so you're going to want to go through some of these. When it says here, well, maybe we should. I'm going to do this one and look at it from just maybe the investing side of things, kind of help you out, and I'll do it for the investing section. When it says here land was purchased with common stock, if we remember back to our beginning rules, back to my part 1 lecture, if your transaction does not involve net income and it does not involve cash, then it doesn't go on the statement of cash flows. This journal entry would have been, if we bought land with common stock, we would have debited our land, credited the common stock. Neither of those accounts affect the net income, and neither of those accounts affect cash. So I'm going to go up here to my land. It says land was purchased with common stock, so the difference here in land of $15,000, I'm not going to use it. Cash wasn't paid for that. And I'm going to go down here to common stock, and sure enough, it's $15,000 up, which is, if that's the only thing that happened to the common stock, that makes sense. My land went up, my common stock went up because of the purchase. So these items in red, I'm not going to even put on my statement of cash flows. So you will not see a purchase of land for $15,000 because A, it didn't involve net income, and B, it didn't involve cash. So let's look at another one. Add an extension to the building. So obviously we added a $60,000 extension. So let's look at maybe real quickly here, what the journal entry would have been. I would have said, debit our building for $60,000, and I would have credited then cash for what I said it was. I paid $5,000, and the rest of it went to the note of $55,000. So did this transaction involve net income? Nope. Did it involve cash? Yes, but just a very little amount, just the $5,000. So when I'm going to my statement of cash flows, that's the only amount that I want to show for my difference in building. Even though the building went up $60,000, I'm not going to use that. What I'm going to need to use is to show that $500 was paid or $5,000 was paid. So I'm going to put this maybe in green as the amount that go ahead and use that number. That's the only number I want to use for my building. Remember, we never use accumulated depreciation numbers, so maybe if it'll help, I take those out as well as I'm going. Remember with the retained earnings, I want to maybe do this as orange. It says I used most of it, but there was one piece I still haven't used, and that's the dividends. And they tell me what that is. They didn't have to, remember, but we did in this case. So the last thing here I'll help you with is the equipment. Let's do a couple of the journal entries to see how these worked out as well. So I'm going to erase this one. All right, our first equipment. Purchase a machine for $47. Oh, I wanted to go back one thing with the building. I need to look at this. I need to see the note payable obviously was adjusted. And with the $55,000 being added on a note, if that note didn't involve getting cash, then I don't want to report that $55,000 difference. So I look down to my note and I see, there's $72,000. So obviously some of my note is being affected here. Some of my note was on a building, which didn't involve cash. So of the 72, I've now explained where 55 of that came from, and it didn't come from cash. So all I have left that I still need to figure out what happened to it was $17,000. 72 minus 55 is $17,000. I'm going to put this one temporarily in orange, meaning I'm not going to go ahead and use it yet, but it is an updated number, something I still need to look into. Okay, let's go down here. Purchase a machine, $25,000 in cash, $22,000 on a note. So my journal entry would have been equipment for machine, that doesn't really matter, equipment of $47,000. Credit my cash, I spent some of it on cash, down payment, and then the rest of it was on a note. $22,000. All right, so now my equipment, obviously the $7,000 I'm not going to use because other things have happened. So with this equipment, so far I know part of this change, I spent $25,000 in cash. So $25,000 paid, but I'm going to want to put that in orange because I still got other equipment things that was going on. So I need to add to that $25,000, but that's going to be a piece of it. Also, I've now looked at another $22,000 of my note. Well, I only had 17 left. I'm actually going to bring this down to a -5. So I had 17,000 addition to my note payable, but I've now accounted for more than 17,000. So in reality, my note at this point has gone down by -5,000. $5,000 reduction somewhere. And I still want to hold off on just to see if everything's done with my note. Again, with this note, I know to take it off and not account for it because I didn't get cash. If I didn't get cash, then I don't want to use it and don't explain it. So I'm at a -5,000 here for my note payable. Okay, we have another equipment going on. Threw out a broken machine. Got nothing for it. Original cost was $10,000, book value of $2,000. Okay, so part of this equipment that I originally had is gone. I need to show that. If I got rid of equipment, that means I also got rid of the accumulated depreciation. The problem told me the book value was only $2,000. So that means my accumulated depreciation had to have been $8,000. And I'm going to skip a line. If I got rid of the equipment and it was on the books at $10,000, I'm obviously not quite done yet. I got rid of the item, but if it has a book value of $2,000 and I got nothing for it, I have a loss on my disposal of $2,000. Okay, so that So there's nothing involved cash here, so I don't need to adjust this number yet. I never adjust the accumulated depreciation, but the loss now. I look down here and it says, ooh, I have a gain of 1,000. Well, obviously part of that gain involved a loss, and let's see how that works out. So I'm going to put down here as a reminder that I had a loss of 2,000. So obviously there's going to be a gain of at least 3,000 if there's only one more gain to offset that, just have a final gain of $1,000. Okay, let's get rid of those and let's look at this last item. Sold a machine for 20,000. Original cost was 30, book value of 17. Okay, so I got cash. It told me I got cash of 20,000. If the book value is 17, that means I got rid of accumulated depreciation of 13,000. That also means I got rid of equipment that was on my books at 30,000 because it said the value of the equipment was 30,000 original cost. My debits and credits don't equal yet, so I have a gain on disposal of 3,000. So let's look at that gain first. That's 2,000 loss offset by a gain of 3,000. That does explain why I have a gain on here of $1,000. And the reason why this gain is a negative is because all of these expenses are taking away from my revenue. Well, a gain doesn't take away, it actually adds to it, so that's why it's a negative. You could have had all of these as a negative and then this as a plus if you wanted to, but that's why this is shown as a negative, because it's not like all the other expenses where we're losing money. We're taking, I should say, taking it away from our revenue. So the last thing here is I've now explained the equipment. I had $25,000 paid, and I had cash coming in of $20,000. So I have $20,000 cash received. Notice I didn't net these two. I don't want to net them. I want to put them on separately. And so now I'm all done with this equipment account. I can go ahead and report this, and you're not going to see it. Maybe I'll just put this down here in the next column so we can see it as a green. I'm going to list each one of these in my investing section. So let's look at that, how that's laid out. Purchase of a building was $5,000. Boom, there it is, $5,000 negative. I spent money. I spent more money here on a purchase of a machine, $25,000. And here it is. And then I received money when I sold the equipment of $20,000. And there it is. So I've now taken care of these. I can go ahead and put them in the yellow category as being done, or whatever category you want to put them in. Now, the last thing, I still have negative $5,000 that I haven't accounted for on my note, saying my note actually went down $5,000 when looking at it just at the cash side of things. And it does tell me here some cash payment was on my note. That makes sense. I paid $5,000 on my loans. And so that's where this is showing up in the financing payment of a note of $5,000. Okay, so hopefully that was a good review of the statement of cash flows, and then looking at things that are non-cash related and seeing how they affect the statement of cash flows. Again, that's going to be the same no matter if we look at the direct or the indirect method. Okay, now let's go in. I'm going to pause it for a minute, and we're going to pull up our My Accounting Lab and look at the two, mainly what we're going to look at this time are the two exercises. Okay, so now I have back up the My Accounting Lab, And I'm looking at the Chapter 12 assignment this time, not the practice exercises. The practice exercises are little snippets of either the indirect method or the direct method. So I think it's best to go ahead and go just look at, and I'm going to do the more difficult one here, the direct method. And this is where I'm going to show you that they don't give you all of the information right up front that you might need to help solve this one. So I think this will hopefully help you a lot as you're going through this one. Otherwise, you might have been really stuck. A few of the things before we get started are these items, and you're going to be coming back and forth to these, and you'll need to make notes on these. I've went ahead and I printed it out. I printed out the balance sheet and the income statement because we're going to be referring back and forth, and I want to know if I've already taken care of that item and what I have left that I still need to take care of. So I think this is going to really help you if you go ahead and print those. The other thing, it's saying here that use parentheses for numbers that are subtracted from our cash. So anytime that we have a cash payment, that's a subtraction, that's a money being spent. All of my numbers over here on the payment side are going to be with the parentheses or a negative sign. So that's another thing to keep in mind that's maybe not clear up front. All right, let's jump into receipts. So this is going to be our cash from our customers, so let's find that. Collections from our customers. Two things we're going to look at. We're going to look at the income statement. So again, I have these printed off. So I'm looking at the income statement. I'm going to make a check mark or somehow note that I'm using the 442, but I don't want to just use the 442, so I'm going to put that on my calculator. Bring up the my accounting lab calculator here. 442,000. But what I want to do with that is compare that. If you look back to your notes, I also want to then look at the accounts receivable from the balance sheet. And my accounts receivable, it says I have one thing also I want to note, when I'm doing my examples, I always put the most current year last, as I'm reading left to right, it would be the furthest right. To me, that makes more sense. So a lot of times in the profession, though, they put the most current year the very first thing you see. So that's something that I have to continually look at the dates just to make sure I'm reading it right. So with this one, the 2013 number, and what I'm going to do as I'm going through this, so you can have a copy and see what I'm doing, is I'll make this sheet available that I'm looking at. I'll make this available to you and put this on the site. Otherwise, your numbers will be different, and it'd be kind of a little bit harder to follow along. Okay, collections from customers. So we got our sales revenue, and then we've got the accounts receivable. And we've got a difference there of $9,700. So I'm going to take the 442 sales revenue, and my accounts receivable for the year went up. So I never even collected that extra $9,700. So I'm going to take the 442 and subtract out the $9,700. And I don't see any other items of income coming in. Okay, so I've got 432,300. I'm going to need to verify I'm not missing anything as we go through this. Let me see if so this is the thing that I'm looking at. Whoops, now see, this has changed since when I printed. That's not good. All right, so just a quick second, I'm going to print this off because my sheet is different than what this sheet is. And I got to be working with the same numbers. So let me go ahead and print this off and print off the income statement. Good thing I saw this right now instead of getting too far into the problem. For those I don't want, so this will be just a second here. Okay. So again, I'm going to make copies of these. I don't know how I'm going to do it yet, but I'll figure out something. All right, so I have revenue, sales revenue of $440,000. And I have accounts receivable going up for the year, so we are not collecting all of the money that we thought. So subtract out $4,200. So I'm getting $435,800. Okay. Let's go on now to the payment. So now I've checked off my accounts receivable and my sales revenue. Cash payments. Remember, the first thing we're going to want to look at is to the suppliers. And the suppliers is going to have 3 different amounts with it, most likely. If we look back to that Word document that I have, you're going to start with your cost of goods sold. So that's $185,800. And then the next thing I want to look at is my inventory. My inventory went up for the year. So if my inventory went up, that means I paid more money. So not only was the $185,800 money that I spent a little extra, $1,400. So add that in. And then the last thing I need to look at is the accounts payable. And my accounts payable went also up for the year of $10,200. So if my accounts payable goes up, that means I'm actually saving a little bit of money. Some of the items that I bought were on account. So I'm going to subtract now $10,200. So I get $177. Yep. And remember, you got to put this as a negative because it's a cash payment. Okay, so I've marked off those items. Next, let's go to the employees. 2 numbers are going to typically be factored in here. We're going to look at the salary expense of $76,000. And then I'm going to look at my wages payable, or salaries payable. Salaries payable went up for the year, so that means I really didn't spend all of this money. So I'm going to subtract out the $10,900. And I'm left with cash spent of $65,100. Okay. Now, the next item is any other operating activities that I have spent money on. So let's look at that. That would be for other operating expenses. So I'm going to look at my sheet. Remember, we don't use depreciation expense, so I'm going to leave that in there, and you'll see why in a minute. I don't mark it all the way out. So operating expenses, $50,500. So that's our starting point. And now I need to look at 2 other items, our last 2 in the current liabilities and assets. Prepaid expenses is the first one I want to look at. It went down for the year. It went from 32 to 22. So if my prepaid expenses went down, that means I saved a little bit of money. So I'm going to subtract 1,000. And then my other accrued liabilities, they also went down. But if my liability goes down, that means typically I spent money. So if I spent an extra $1,300, then I need to add in. So we have the $50,000 minus the 1,000 that I saved, $50,500 minus 1,000 plus the 1,300 gives me cash spent of $50,800. And then my last 2 are generally the easiest. For interest, cash spent $24,200. And for income tax, $28,700. Okay, now we'll go ahead and add all these up as a negative number. So $177,000 plus $65,100 plus 50,800. And I get total cash payments of 345,800. So I'm going to write this in negative. And the last thing now, cash provided from my operating activities, simply subtract these two. $90,000 I actually received positive money, the cash collections being the larger number. Check our work. Good. Now let's go to the investing activities. So I'm going to look at my, it tells us here, let's read this. We had no non-cash investing or financing transactions. So everything involved cash is basically what that's saying. So it's kind of hard to read, I think, just knowing that everything involved cash. There were no sales of land or equipment. Okay, so if there were no sales, that means no gain or losses. Any items that went up or down in those items would have to be purchases, kind of what that's saying as well. No gain or losses, so everything is going to be a purchase. No payment on our note, no return of stocks, no treasury stock. Okay, so let's look back to the balance sheet and the investing section that's going to deal with our long-term assets. Land, it went up by $39,400. Land doesn't depreciate, so that's why it doesn't say net there. Remember on my example, I put the accumulated depreciation. On this one, they just combine it and say like equipment, comma net. That means that's what it's listed now as its book value, not what it's really on the books for. There is not equipment on there for, say, the 62,100. That's the value of the asset minus its depreciation. So we're going to need to keep that in mind when we get there. Okay, so cash investing from land. We purchased land, so here's purchase of land. And if I purchased land, that would again be a negative. I spent money of $39,400. My equipment also went up. So if my equipment went up, that would be a purchase of equipment. But I can't just jump in and say, ooh, I bought equipment worth of $12,700. Not quite. I actually bought equipment worth more than that. Because remember, that equipment account, that new number includes the accumulated depreciation. The accumulated depreciation for the year, for this most current year, went up. Why does accumulated depreciation go up for the year, therefore taking the asset value down? Because of the depreciation expense. Looking at the income statement, our depreciation expense is $16,800. If that $16,800 wasn't there, therefore it would not have affected the accumulated depreciation, and my asset, the equipment, would have been another $16,800 higher because we wouldn't have taken the value, the book value of the equipment down. So really what I spent on the equipment is the difference. I not only spent the $12,700 that it shows as still an increase on our books, but I also need to add back in that depreciation and pretend it's not there. So add in the $16,800, and that's going to show me $29,500. That's what I really spent in equipment. I know that's kind of confusing. Try to use some more examples to think through that on what I'm trying to really say here. Maybe make T accounts if that's going to help you, and to see how the book value is going to go down. So if I didn't buy anything for the year, my equipment net would have went down by $16,800. My equipment would have went down. I didn't sell any equipment. It looks like I did, but just because of that depreciation being in there makes it look like I sold it when I really didn't. So I would need to add that $16,800 back in to get back to a zero if I didn't buy or sell anything. But in this case, not only did I not sell anything, but I bought something, so I need to add that $16,800 back in. So now the $39,400 plus what I've spent on the equipment, $68,900. And the last section, the financing. So now I've taken care of the land and the equipment. I've taken care of the depreciation, how that's going to be affected. Last few things, I got a note, common stock, and then remember retained earnings is only partially done. There's one thing left that we have to look at for depreciation or for retained earnings. And this is something that I give you on my sheet as help, as just go ahead and give you the number. They on the, this is where I think it's harder because of that depreciation issue and this retained earnings issue, why this problem is harder than it probably needed to be, but they're making you think, which is good. First thing, though, I'll say I look at is my note payable. My note payable went up for the year, and it's telling me everything involved cash. So if my note payable went up, that means I got money. I took out a loan. So the issuance of a note payable, I received $34,000, and that was actual positive money. I got money, so that's going to be a positive number here. The next thing I have is common stock. Common stock was issued for $22,600. So I got money. The last item here, remember, and usually we'll have this, is dividends. Now, you look and you won't find dividends anywhere on the income statement or the balance sheet. It doesn't go there. Remember, it goes to the statement of retained earnings. So we're going to have to calculate now what the dividends really were. So if you think back to the statement of retained earnings or the statement of owner's equity, whatever you want to call it, you always take your beginning retained earnings number. So let's get our beginning retained earnings. That would be the end of last year, 34,100. Add in your net income for the year. That would be 58,000. And then simply subtract, well, you can get a total here. So that's saying if I didn't spend any money on dividends, my retained earnings should be 92,100. Obviously it's not. I've spent some money on dividends. So my actual retained earnings is 62,800. So I'm going to subtract out what the retained earnings should have been based on what it really is, 62,800. And that's going to be how much is the difference. Whatever's left over is the dividend payment that I had, that I made out. So I made a $29,300 dividend payment. Now we're going to get the total here, 34,000 plus 22,600 minus 29,300, and I get a total cash provided was 27,300. Now I do the final step. Net increase in cash. So now I'm just going to add up the three totals that we had. 27,300 minus 68,900 plus the 90,000 from operating. 48,400 positive. Now we add that to my beginning cash for the year or the end of last year's cash. And looking at it, it is 16,400. Add these two together, 48,400 plus 16,400 equals 68,400. Look at this year's cash, and that does match 64,800. Let me see what I did here. Okay, net increase in cash, 48,400. Everything seems to have worked. Let me see if I typed in something. I'll add them one more time just to make sure. Again, 90,000 minus 68,900 plus 27,300. 48,400, that's an increase in cash, good. I had beginning cash of 16,400. Okay, oh, I know what I did. I didn't put in this. I thought I did, but maybe I didn't click it right. That's the difference. Now let's check it. So there we go. I had the numbers right. For some reason that didn't pop up. You can easily do here part 2. It's just a multiple choice. But that's how we're going to look at the direct method. The last thing I wanted to look at was problem 1. And this is preparing an income statement and a balance sheet. It's basically putting everything together we've done. And this is also something that you may want to go ahead and print out. And what I would do with this one is have a complete T account page. And I may even just make it somehow get your, have a T account page that I have provided in prior weeks, or make up your own. And I'll go through a couple of these. So I'm going to have a T account page. I know it's kind of hard to see, but I got my assets plus my liabilities plus my owner's equity minus my expenses plus revenues. And each one of these I'm going to go through and actually do the journal entry for it. That's the only way I'm going to be able to get what my total revenues are, my total expenses, and then doing the balance sheet as well. So I'll go through a couple of these, and hopefully you can see when I'm going to write it in there. Hopefully this will be a little darker. So we issued common stock of $430,000, and then we made the following cash payments. So okay, we started out with cash. Because we issued the stock, we had cash as our debit of $430,000 and a credit to our common stock account of also $430,000. And then it says I spent $160,000 on equipment, so I'm going to go down towards the bottom of my assets and put the equipment of $160,000 and credit to cash to update my cash account. On part B, I'm going to want to make a side sheet and do the inventory calculations. Doing it it's going to tell us which way we're going to do it. It tells us here we're going to do it the Fifo method. So to help keep track, I'm going to want to separately make a little inventory sheet that shows I have, right now I have inventory on my books worth $234,000, but how that's separated out for when I do it in Fifo. 6 cars at $39 each, I'm going to need to see that. So I have inventory on my books of $234,000, and subtracting out the cash, because these were all cash payments. So I'm going to need to update my cash. And then I also paid rent, so that would be a rent expense of $18,000. For the building. Again, crediting cash. So far as I'm going, I would be having T accounts for all of the items that have been listed so far. So I've got the cash going, I've got the inventory, and the equipment, I've got my common stock, and I even got the rent expense showing up. I'm going to go through each one of these and do the journal entry, and then I'm going to be able to get my final balances for each category. I think this is a good overview of how well you really know the material, how you know how to do a gain or a loss, how you know how to sell inventory and update your inventory T accounts. This is going to really give you a good overview of everything we've done so far. So hopefully, if you like accounting, you're going to enjoy this problem. If you don't, this problem is going to be pretty tough for you, I think. All right, I think we're going to stop it here. And I will see you for one more week. Well, we may have one final week, I don't know, but at least one more week for Chapter 13 material.